the portfolio that I've seen among our clients who had the best returns were well structured and were experiencing very few changes.
Today, it's all about asset allocation. So first of all, what is asset allocation?
Asset allocation is the proper structuring of your asset across asset classes in order to achieve your investment objective adjusted for risk. I think a good representation of the experienced investor should be prepared for is the so-called envelope charts. You calibrate a portfolio to deliver certain objectives, but you understand that the shorter the horizon, the more uncertain the returns in that short-term horizon. And therefore, as long as you are within the envelope of expected outcome, you're on track to achieve your objectives in the medium and long term.
Okay, so it's about having this long time horizon. It's not about kind of going from headline to headline. As long as you're roughly moving in the right direction, that is what you're aiming for.
Absolutely. In my career, the portfolio that I've seen among our clients who had the best returns actually were well structured and were experiencing very few changes.
So there's a strategic asset allocation that you look at, but there's also a tactical allocation. But when it comes to strategic asset allocation, what should people focus on? Is it just simply bonds and equities? What is it?
There's a broader range of asset classes that one can consider. But for each of those asset classes, in each one to which you consider making an allocation, you should have a very, very clear understanding of what that asset brings to the portfolio. Am I enhancing returns? Am I diversifying, mitigating risk? And critically, what is the source of return in the asset class? Even for traditional asset classes, bond and equities, the source of the return is not always well identified and understood by investor. And even more so for more exotic asset classes, sometimes the source of return is very attractive. An example is the so-called cat bonds, the insurance-linked bonds. They clearly display a payoff pattern that is diversified from traditional asset classes because the source of the return is completely independent from the economic and financial cycles. So you need for each of those asset classes to really understand what benefits they bring to the portfolio. And of course, you have to have a view as to how they are priced, what are the current investor collective expectation embedded in the asset price, and therefore, is the risk-reward still favorable going forward?
What should investors then strategically focus on? And how personal is this? Because I guess there's a lot of home bias for some people involved. There's currency involved in this. I kind of want to put you on the spot and ask you for kind of what's the standard portfolio, but I hesitate because that's kind of impossible, right?
Capital markets and the broad opportunity set is the same for everyone. So that's the given starting point that is common to every investor.
So you have the same ingredients.
But you have the same ingredients. Now, the regime or the recipe, your diet, might be slightly different depending on where you live, what your reference currency is, what your spending rule is, if you need the money or not, and critically, your wallet bent, And let me maybe give you an example. And this is really a Swiss perspective, because we have a lot of clients who think in euro, we have many who think in dollar, but we also do have clients who have the blessing and the curse of thinking in Swiss franc. It's a blessing because the Swiss franc is a very good store of value among leading currencies historically. The problem is deploying a large amount of capital in Swiss capital market is a big challenge simply because of the nature and the size of the country, right? Swiss bonds are not very compelling proposition other than the currency because they're very low yielding instruments. Plus the market is illiquid, difficult to trade, and again, maneuver in size within. The equity market is a very good asset class in the long term. We tend to say it's a market of stock rather than a stock market. And that raises very substantial portfolio construction issue when you manage its equities. And finally, there is Swiss real estate, either in direct or securitized form. But again, it's an asset class that is not so easy to implement and access effectively. Therefore, if you are a high net worth individual, obviously your reference currency is the Swiss franc. You're going to have a substantial share of your assets in Swiss franc. If you are a ultra net worth investor, and when we talk to family offices, for instance, and the size of your portfolio is significantly larger, I would argue, yes, you do the accounting and the portfolio reporting primarily in Swiss franc, the currency in which you pay your taxes. But, truth to be told, your reference currency is the dollar, and your benchmark is the S&P 500. And the reason is very simple. A large portfolio, broadly diversified, will have a much better opportunity set when you take a dollar perspective of the world. The dollar historically has depreciated by 2.5% annually compounding against the Swiss francs since currency floated in 71. But the return on US dollar assets is significantly higher than the return on Swiss assets in local currency terms. And very critically for a high net worth individual, if you keep up with the S&P 500, you are performing in line with your peers, because entrepreneurship, company ownership is one of the prime source, if not the prime source of wealth creation in the world.